The high-frequency trading debate continues to rage on. Now, Dan, you represent an exchange, and in your prior life, you were a trader on a very active desk. Why is this such an issue? Because I don't think the average person really understands what this is all about. So break it down for us.
It's a huge debate right now, a lot of public attention, very misunderstood, in my opinion. High-frequency trading in its simplest form, and hopefully not oversimplifying it, but it's basically high-speed computers with high-speed connections placing a rapid amount of orders at a given time. It's a tool. The debate so far has been, is HFT good or is it bad? And it's really neither. It is just a tool. It's a very necessary tool, and it's something that's not going away. Really what the debate should focus on are probably predatory practices, not HFT in general, but certain practices within certain firms that may take advantage of other market participants.
And that's the question. We hear the term spoofing a lot. Now, when we got our Series 7 101, basic is if you flash out an order, you have to represent that and you have to fill it. And the common concern traders have is they're not getting filled and these bids are pulled. How can that happen?
Absolutely. Well, that's the key question. How does someone get a first look at an order before it's actually traded, before it's actually matched? And what we see with this spoofing, and probably kind of to break it down a little bit for the average person because it gets very complex, if I was looking to buy 20 tickets to a baseball game, and I go onto a website and I see, oh, hey, here's 20 tickets at $10. Great, I put my order in. Before it actually gets filled, the person sitting on the other side actually sees my order and pulls 18 of those tickets. So now I get filled 2 tickets at $10, and the other 18, all of a sudden I have to pay $12 for. And that, in essence, is spoofing. It's something that appears there, but then is just pulled away.
So it's really having control over the whole supply-demand function of the market. Because they see what the supply is, they see what the demand is.
Absolutely. They have a first look. And we're talking in sub-second speeds, but they have a first look. Computers are designed with the algorithms to take advantage of that. Very unethical. We're starting to see more and more lawsuits. And this really isn't a new debate. Go back to the '87 crash, Wall Street Week with Louis Rukeyser. They were talking about computerized trading and what it would do. They had no idea, I'm sure, at the time of the Frankenstein type applications that would be created. But it's not a new debate, but it's one that really needs to focus on exactly the issues, not just the whole spectrum of high-frequency trading.
Right. Well, breaking down to the issues, I also think you need to get regulators. I think a fantastic scenario would be have regulators that were ex-traders that know exactly what to look for.
Absolutely. There's really a novel idea, right? People that really understand the structure, because it's really a structural issue in a lot of cases, having those regulators. And trust is really the thing right now. As this debate rages on, it's really trust in the overall system, which was already pretty battered from 2008.
Right.
And I'm hearing that from the members of our exchange quite often. It's like, where do we go? Who do we trust?
Okay, well, I'm sure we'll be meeting up quite frequently to continue this discussion. Thanks very much, Dan.
Thank you.